Investment is the process of putting money into an asset or a business with the expectation of earning a profit in the future. Investing can help you grow your wealth, achieve your financial goals, and beat inflation. However, investing also involves risk, as there is no guarantee that you will get back your money or earn a positive return. There are many different types of investments, such as stocks, bonds, real estate, commodities, cryptocurrencies, and more. Each type of investment has its own characteristics, advantages, and disadvantages. Some investments are more volatile than others, meaning they can fluctuate in value more frequently and unpredictably. Some investments are more liquid than others, meaning they can be easily converted into cash when needed. Some investments are more tax efficient than others, meaning they can reduce your tax liability. To be a successful investor, you need to have a clear understanding of your investment objectives, risk tolerance, time horizon, and personal preferences. You also need to have a sound strategy that suits your style and goals. You can either invest on your own or seek professional advice from financial planners, brokers, or fund managers. Today, I want to introduce you to one of the most interesting and successful investors ever and to 10 strategies that he has given to people who want to invest in the stock market. Peter Lynch. Peter Lynch is the legendary former manager of the Fidelity Magellan Fund, which he grew from $18 million to $14 billion in 13 years, beating the market by a wide margin. He is also the author of several best-selling books, such as One Up on Wall Street and Beating the Street, where he shares his insights and strategies on how to invest in stocks. In this video, I will tell you about 10 strategies that Peter Lynch gives to people who want to invest in the stock market. Let's get started. Number 1. Invest in what you know. This is one of Lynch's most famous slogans. He believes that individual investors have an edge over Wall Street professionals because they can spot opportunities in their own fields of expertise or everyday life. For example, if you are a teacher, you might notice a new educational software that is popular among your students. Or if you are a shopper, you might notice a new brand that is selling well in the stores. By investing in what you know, you can understand the business better and have more confidence in your decisions. Number 2. Do your homework. Investing in what you know is not enough. You also need to do some research on the company before you buy its stock. Lynch suggests looking at the company's financial statements, annual reports, industry trends, competitive advantages, growth prospects, and valuation ratios. You should also check the company's history, management, vision, and culture. The more you know about the company, the better you can evaluate its potential and risks. Number 3. Look for growth at a reasonable price. Lynch is not a pure value investor or a pure growth investor. He likes to find stocks that have both growth and value characteristics. He calls them GARP stocks, which stands for growth at a reasonable price. These are stocks that have strong earnings growth, but are not too expensive relative to their peers or the market. Lynch uses the PEG ratio to measure GARP stocks. The PEG ratio is the price-to-earnings ratio divided by the earnings growth rate. A PEG ratio below 1 means that the stock is undervalued relative to its growth potential. Number 4. Diversify your portfolio. Lynch believes that diversification is important for reducing risk and increasing returns. He recommends holding at least 10 stocks from different industries and sectors. He also suggests having a mix of different types of stocks, such as cyclical stocks, defensive stocks, turnaround stocks, asset plays, and fast growers. Cyclical stocks are those that follow the ups and downs of the economy, such as airlines, hotels, and automakers. Defensive stocks are those that are stable and consistent regardless of the economic conditions, such as utilities, consumer staples, and health care. Turnaround stocks are those that are recovering from a slump or a crisis, such as bankruptcies, scandals, or restructurings. Asset plays are those that have hidden or undervalued assets, such as real estate, patents, or cash. Fast growers are those that have high and sustainable growth rates, such as technology, biotechnology, or retail. Number 5. Be flexible and adaptable. Lynch warns against being rigid or dogmatic in your investing approach. He says that you should be willing to change your mind when new information or circumstances arise. You should also be open-minded and curious about new ideas and opportunities. Lynch says that he learned a lot from his mistakes and from listening to other people's opinions. He also says that he was not afraid to invest in different kinds of stocks or different kinds of markets. He says that you should be able to invest in any market condition: bull markets, bear markets, sideways markets, or choppy markets. Number 6. Be patient and long-term oriented. Lynch advocates for a buy and hold strategy that focuses on the long-term performance of the company rather than the short-term fluctuations of the stock price. He says that you should not be distracted by noise or emotions in the market. He says that you should ignore the daily headlines, rumors, tips, forecasts, and opinions of others. He says that you should only sell a stock when there is a fundamental change in the company or when you find a better opportunity elsewhere. Number 7. Let your winners run and cut your losers short. Lynch says that one of his secrets to success was finding 10-baggers, which are stocks that increase tenfold in value over time. He says that these 10-baggers can make up for many losers in your portfolio and boost your overall returns significantly. He says that you should not sell your winners too soon or hold on to your losers too long. He says that you should let your winners run until they reach their full potential or until they show signs of deterioration or overvaluation. Number 8. Don't chase hot stocks or fads. Lynch warns against following the crowd or jumping on the bandwagon of popular or trendy stocks. He says that these stocks are often overhyped, overpriced, and risky. He says that you should avoid investing in stocks that you don't understand or that you can't explain in a simple sentence. He says that you should also avoid investing in stocks that are based on speculation, rumors, or hope rather than facts, fundamentals, or logic. Number 9. Don't be afraid of small or obscure stocks. Lynch says that he found some of his best investments in small or obscure companies that were overlooked or ignored by Wall Street analysts and the media. He says that these stocks often have more room to grow and less competition than large or well-known companies. He says that you should not be intimidated by the lack of information or coverage on these stocks. He says that you should do your own research and analysis and trust your own judgment. Number 10. Have fun and enjoy the process. Lynch says that investing should not be a chore or a burden, but a hobby or a passion. He says that investing should be fun and enjoyable, not stressful or frustrating. He says that you should have a positive attitude and a sense of humor when investing. He says that you should not take yourself too seriously or take the market too personally. He says that you should learn from your experiences and celebrate your successes. These are the 10 strategies that Peter Lynch gives to people who want to invest in the stock market. I hope you found this video helpful and informative. If you did, please give it a thumbs up and subscribe to my channel for more videos like this. And if you have any questions or comments, please leave them below. I would love to hear from you. Thank you for watching and happy investing.